Hello there, John Hardy here with another edition of the Video FX Update this Friday, March 11th. Back to the drawing board. We have seen the dollar, after making quite a tease yesterday with breaking through some technical levels to the strong side, reversing course pretty violently today. Let's have a look. Euro dollar, we saw, of course, this 138.60 area fall quite heavily yesterday. It even took out this rising trend line. All turned out to be a tease so far with the pushback higher. Of course, we can make the argument that we're just headed for a 618 retracement, and we did weaken the trend by moving below here. But obviously, the immediate concern for anybody trying to short Eurodollar would be that that today doesn't really support that notion, to say the least. Aussie, the action in Aussie dollar even more violent, with an incredible engulfing formation. And again, this yesterday comes after a very sort of convincing looking break of the 55-day moving average. It fooled us, certainly. We looked at this as a potential trigger for further downside, but markets across the board not supporting that move today. Also took out this rising trend line, and of course now we're snapping back higher, and everyone's going to be looking for that 102 again, like we were here, here, and here, and here. Of course, again, having a hard time getting out of the parity to 102 range in Aussie dollar. Back to our points. Today's highlights, of course, the big dominant development here, whether it's financial markets or whether it's concerns for people's lives and safety, and that is the Japanese earthquake, this terrible earthquake, 8.9 on the Richter scale. And remember the logarithmic scale here, so Christchurch, New Zealand was 6 point something. This is 8 point something. It's 100 times worse in terms of the violence of the earthquake. Touched off a huge tsunami, which apparently did the most of the damage, as the Japanese building codes are so strict now after the Kobe experience of '95 on ensuring that that everything is up to code, up to snuff in terms of withstanding earthquakes. And markets trying to vulture speculators out there trying to descend on the yen and buy it because of the idea that we'll see a repeat of the Kobe experience in '95. When the yen went stronger very sharply for a while. Repatriation of government and private assets abroad to come back and pay for the damage, insurance money coming into the country to pay for the damage, or what have you. Of course, on the negative side, we have to consider what this means for the Japanese economy. How significant is the damage? This is a very sort of small area in terms of GDP importance for Japan. So the initial report from our impressions this morning, anyway, were that it was a remote area. Yes, it's a terrible earthquake, but that because it was a relatively remote area, this would be relatively small in terms of the damage relative to Kobe. But having seen some of the anecdotal evidence of what is going on over there, I'm not so convinced, and certainly the damage is going to run up into the tens of billions of dollars. I mean, you have train networks down, mobile networks down, factories shutting down, and the risk of some kind of radioactive cloud release from a nuclear plant that may have been slightly damaged. I mean, this is pretty heavy duty stuff for the country, and of course we're all concerned about the loss of life, but there's also significant financial damage, and you wonder how long the yen can strengthen on a situation like that when the economy was already weak. Okay, moving on. Chinese data. Are the wheels still coming off? We still have very strong and huge growth in fixed asset investment and industrial production. At the same time, the latest retail sales data come in far slower than the previous months, more towards 12% rather than 19%. So the idea being that this attempt to switch to more consumption away from massive overproduction is not really working. And as well, the consumer inflation level is still very high there, so it adds to, of course, to the concern that the Chinese regime will still need to clamp down further. Oil is back higher. At first it was a bit lower on the Japanese news because of refineries shutting down. Of course, that would mean they would need less product, but they're back higher as of course the situation in the Middle East is not finding any kind of resolution. And I would say the fear is that if Gaddafi does indeed manage to pull out a victory, are there any, at least European and major Western powers that will want to trade with the man after what he's done? And I think it'll be sort of for humanitarian reasons, considered not a popular thing to do. So that oil supply maybe offline for the duration if Mr. Gaddafi's forces win. Elsewhere in the European news, we had the UK PPI data out low. Core data was quite low relative to expectations, only 0.1%. This had people pushing out the expectations for the first Bank of England rate hike further out the curve, and this damaged the sterling's prospects, with euro sterling up closer to the recent highs, well above 86. And cable was down slightly below 160 at one point. And of course, that's bounced quite a bit with the weak dollar today. Later in the day, I should say, because it was quite strong before it suddenly weakened. An ugly Canada employment data point. This one didn't look so ugly on the headline. I think there was 15K growth versus 25K expected. This was after a tremendous month in January of 69K on the positive side. But on the internals, we had an outright fall in the number of full-time employees, and that's not so great. And Canadian dollar has been generally weak in the crosses, even if it did manage to pull back against the dollar later in the day. Elsewhere, U.S., very strong retail sales, and the previous data being revised higher. And they were also strong without, or if you take out the auto and gasoline components, which is an extra sign of strength because people are paying a lot more for gasoline, meaning that their overall spending is growing quite a bit on top of what it was before. On the other hand, the most recent confidence data has suddenly crumbled as, of course, this Middle East situation and the spike in gasoline prices is potentially getting on people's nerves. Market apparently willing to sort of say this is a temporary thing and we'll quickly get over it. Looking at themes, obviously the dollar not able to catch any kind of break at the moment. Direction is hard to find. And if we're to use 2020 hindsight, we did know yesterday that interest rate spreads had gone nowhere either, and they have been a main driver. And that should have been a bigger note of caution than it was in trying to set up the idea that this could be a beginning of a more significant move. On the other hand, we haven't seen anything today that encourages the opposite view either, as these rate spreads have not really stretched either way convincingly at all in the recent week. So almost any directional move is jaundiced at the moment until we see some kind of more firm follow through across markets. It is all about QE3 still. QE2 pretty much priced in, and apparently if you look at let's say the March 2012 and the June 2012 euro dollars as an example in the futures, these of course are projections of where the short-term rate is going to be out further out down the line. They're trading at new highs for the year, suggesting that the expectations for the FOMC are at new lows for the year, despite $115 Brent crude, and of course with the ECB, the wild ECB expectations up to 120 basis points on the positive side. This is making it hard for any Eurodollar sell-off to gain traction, and that's going to need following going forward. Of course, we'll get to this in a moment with the looking ahead on the calendar. In the meantime, one last thing, special focus: copper and China. Very interesting article. I tweeted this out earlier in FT Alphaville about how copper is being warehoused in China instead of being used in houses and apartment blocks and cars and what have you. They're being warehoused and used as collateral in financial transactions. This on top of the fact that it's being used and warehoused as and financialized as an ETF in Western markets makes you want to believe that at some point when people are tired of playing hot potato with this or sort of the greater fool theory with this metal, in other words, just buying it in the hopes that it goes up and you can sell it later to the next bidder for a higher level, we're going to see a massive crash in copper. A lot of the loans going on in China have to be property related, have to be bad, will sour at some point, and when they do, this copper is going to come onto market, and it won't be pretty. And keep that in mind with Aussie. Of course, it's trading higher today, maybe set up for run at 105. Who knows in the short term? But at some point, instead of 101 or 102 in Aussie dollar, we may be looking at 71 or 72 in Aussie dollar sometime in the next 6 months, depending on how this, of course, shakes out with the Chinese banking system and with the copper market. Looking ahead, we've been a bit remiss in not pointing out FOMC meeting next Tuesday. It's only a one-day meeting instead of the two-day one, the theory being that maybe they have less time to discuss and make impressive new statements, etc. But signs of perhaps some trepidation, some fear that what they're doing is causing a bit less, or a bit of worry in markets, I think, and I'm sure they're worried about the crude oil price, regardless of what they're saying. that core inflation is the most important thing. So, of course, there's some chance that they back off their language a bit, but I think more specifically, it's more interesting to see how they describe their intentions on how QE2 will end. Is there going to be some kind of tapering, or will it just simply cut off at the end of June? As well, we have to look at the possibility of a dissenting opinion. I think this is the first time where we're getting much higher odds of at least one, that being either Plosser or Fisher, going into just say no mode and voting against any further extension of QE2. So that's quite interesting. But judging from Eurodollar stirs and judging from equity markets making quite a bounce back today and the dollar selling off, it seems like the market is trying to put on the QE3 trade here. As well, we have lots of noise out of Europe, a lot of the peripheral countries increasingly in trouble, but the market seems to be saying, look, the ECB is going to hike, and the pigs can oink all they want to, as long as it's only the very peripheral countries that are seeing rate spreads go higher. In Greece, basically at guaranteed default interest rates right now. That's fine and dandy for traders right now, as long as it's the peripheral countries. So we need to keep our eye on the likes of Italy and Spain, rather than the PIG countries. I should have left the S off here, obviously. So keep that in mind. And the EU summit, of course, upcoming on March 25th. All right, let's have a brief look at the charts here. We had a look at Eurodollar a little while ago. 139.25 would be an area if we're going to look for a 618 type of retracement. That would be actually one of those classic retracement levels. We've damaged the uptrend a little bit by moving below this 138.60 level. The bounce back, meaning that we should look for the 139.25 and wherever the 764 retracement level is. And of course 140 is still capping the action here. And as long-time viewers know, we're quite jaundiced on the view that the Eurodollar is ready to make any significant gains above this range here. Cable 160 was basically held. It didn't hold in terms of the actual level. It traded briefly below there, and so this is the range now, with 160 as the low, and of course we look for a bounce. But this latest sell-off really damaging the sort of the grinding uptrend. So higher within the range is, I think, the best bet, or the best prospect we can come up with for cable on the upside, and eventually I would look for a retest of the lows. Euro sterling higher. We did talk about this being a bullish technical event yesterday, even though we don't like the idea of euro heading higher, but higher it did go, and this 87 area, or 86, whatever this level is, 86.80 or so, will be the next focus for that pair. Again, if we purely to go by interest rate differentials and ignore the whole pig sovereign debt crisis, you could justify euro sterling trading at 88 or 89. So as long as pigs remain sidelined, as long as the market is encouraged about the outlook there, the risk is, with as long as the ECB expectations remain high, that it could even trade up at those levels. Also making some sense with risk coming back today, we have euro sterling bouncing, and this 55-day moving average is an interesting one here. Yen, of course, we talked about why the dollar yen corrected so rapidly. Why am I not getting a chart here? It doesn't matter. Obviously I did something that we can't see it, but it's actually trading right close to the trend line there on the dollar yen. Euro yen also affected, but you see it's bouncing a bit there, more than the dollar yen is with the weak dollar. If we go to a dollar yen chart, here's that old trend line, of course suddenly being threatened, but we have quite a one-off event that's happened here. So let's see what happens on dollar yen. Dollar CAD, nice rally. It rallied right to the 21-day moving average. Did not take out the 98 to 98.50 zone. That seems to be the next big resistance area, and this suggests we just had a short squeeze here with risk coming back, oil still relatively stable, etc. I have a hard time arguing for dollar Canada making a stay on the high side. Aussie dollar, what a tease yesterday it was. We've had copper bouncing today, risk bouncing today, bonds selling off a bit, and with the strength of this is actually one of the biggest up days we've seen since here. But this one didn't lead to a breakout either. So let's see if we can take out 102 and see if it holds for any length of time. again, longer term, bigger picture, we're pretty cynical on what's going on with the Australian economy, its dependence on commodity exports, but as long as China can stumble along for another quarter or so, it's going to risk heading higher. A show of strength from Kiwi, as this 200-day moving average hasn't held in Kiwi dollar, and this new low from the past here is not holding either. Sets up the risk of further consolidation. This is dollar yen, where I took it back to 1995. Kobe earthquake happening here towards the end of January, and we see how this saw the final down leg for dollar yen. But again, with these kinds of events, it's a one-off thing, and that quickly faded further along in the year. Of course, other factors could have been involved, but we see the immediate aftermath, and this is why the market is trying to place bets on the yen strengthening, thinking that it's learned a lesson from the past here. We've pointed out dollar MEX. It broke lower, decided yesterday nope, and decided today yes anyway, and that is a sign of a strong risk appetite in this market at the moment. Crude oil, actually it's come back lower since I started this presentation. It's close to 115 last time I looked at it, so it is a bit lower at present, and despite risk trading higher, or and allowing to risk to trade higher, I should say, possibly. Again, the 55-day moving average in the S&P 500, very critical in a technical sense. We did trade below there in the futures and pre-market, but this is quite a line in the sand. We pointed out yesterday, this goes all the way back to September, 1st of September last year, this moving average, which is held. So it also now, we're trading back in the range back above this old low. So the bears need to prove themselves on risk-wise to get further traction. And this shows the March 2012 short sterling future, again showing why sterling was so weak today. Quite a jump, some 10 ticks or so possibly from yesterday. That's taking quite a bite out of the forward expectations of the BOE. Quite a bite taken out of ECB expectations as well. Look at this, we've taken out almost everything from that most recent ECB meeting, and yet we've taken out even more elsewhere, so the euro is still relatively strong. Let's see if 139.25 holds though. Not much encouragement from the BHP for Aussie, but it did rally today, and that's giving some short-term support to this Aussie dollar move higher. So again, a very treacherous market here, back and forth everywhere. Let's see how we trade next week. Maybe the market just a bit nervous because it broke, and then we had the Japanese earthquake situation, and then of course when the break doesn't hold, everyone rushes to get out of those positions. We also have the key event risk of the FOMC coming up next Tuesday, so we're still in limbo. Let's see if the FOMC on Tuesday provides any sort of watershed event that can get markets moving in a more sustainable direction after that meeting. In the meantime, have a wonderful weekend out there. Say your prayers for everybody in this involved in this Japanese earthquake. We'll hope for the best as they try to recover from that terrible situation. In the meantime, that's it for this week, and we'll be back next week with another edition of the Video FX Update.